Hello everyone. Welcome to this channel. My name is CP Otieno. I am a certified public accountant of Kenya, and today I feel I need to take you through some of the accounting concepts that people need to understand for you to be a good accountant, for you to be able to handle a number of accounting questions if you are a student. Then I believe this is the channel for you that will take you through step by step so that you can be able to finish up your course. Yes, I welcome all the CPA students. I welcome all the degree students and the master students, those who are taking different accounting units. Kindly feel free to interact with this channel so that we can move somewhere. And even those who are taking their personal businesses and you would really want to get to understand how the accounting is normally being done by your employees, just to get a grasp of what accounting concepts are. The Bible says that my people perish because of lack of knowledge. So I want to welcome you today so that you can get the knowledge on accounting. Let us start by answering a few questions. Here we have questions that we are going to use in this study. So we are going to start by answering these questions. Let's start by question number 1. What is accounting? What is the basic concepts of accounting? What is the double entry concept? What are financial statements? What are the contents of financial statements? Once we are done with answering all those questions, we shall have a good background of accounting, which can help us now come into the bit of doing calculations. When we shall be now handling the crediting and debiting, you will be able to know why we are doing the crediting and debiting easily. Yes, so first of all, let us develop the background of accounting, then we can proceed. In the next lesson, we'll be able to break down the crediting and debiting aspects, and that will be the order of the day. So for today, allow me to move with this theoretical bit of it so that you can get to understand. Question number 1, I said we are handling what is accounting? And I said, as per our definition, which I've really decided to make brief, it is the system of recording, summarizing, and analyzing an entity's financial transactions. In some other definitions, you will realize it is defined as a process. The major information there is a process. It is not a one-time, or it's not a one-time activity, but it is something that it is a continuous process. So in some other definitions, it's given as it is the scientific approach of recording, summarizing, analyzing an economic entity's financial transactions. Some also say it is the scientific approach or process of recording, summarizing, and analyzing an entity's financial transactions so as to come up with financial results being presented to the financial users. The second question is saying, what are the basic concepts of accounting? The first concept that we have here is accrual concept. This is the concept that states that revenue is recognized when earned and expenses are recognized when assets are consumed. This concept means that a business may recognize revenue, profits, and losses in amounts that vary from what would be recognized based on the cash received from customers or when cash is paid to suppliers and employees. What that one simply means, or in other words, you would say that accrual concept is the concept that states that revenue should be recognized when it is earned, not when it is received, while expenses are supposed to be recognized when they are incurred and not when they are paid for. An example in this circumstance would be, let's say you are paying for security services. You've been given security services by a security company for your business. This is part of the expenses that you have. So let's say your business is running from The financial period runs from 1st January to 31st December of a particular year. So within, as you prepare your financial statements at the end of the year, you realize that the month of December security fees have not been paid out. So that security fee for the month of December becomes the accrued expense. So we have to recognize it in the financial statement of the period that we are handling, that I said is starting from January up to December. So that is recognizing the expense that has been incurred, which has not been paid for. That is what the accrual concept says. And relating to income, when an income has been received, let's say you've given a service to a certain company, and then this company is supposed to pay you back. So this company, by the end of the financial period, you've not been able to receive the income that ought to have been paid by that particular company. So you don't ignore that information. You pick that information and record it in this particular period, because it is an income that has been earned in this financial period. So however much it has not been received, it is this year's income. So the accrual concept will guide you and dictates that you need to recognize that income even though you have not received it. So that is what will bring in the confusion, where people try to compare the revenue against the cash at bank or the cash in hand. I would say that most of the time, or rather, I don't want to remove completely that revenue and cash can never be equal. But I would say that most of the time you will realize that they are not matching. Why? Because of this accrual concept. At times, we recognize revenue before we receive the actual cash. So there is a bit that I will explain to you later on about the cash basis of accounting. So today, just know that in accrual concept, this is the concept that dictates that revenue must be recognized entirely in this financial period, as long as we have an information that it has been earned. So whether it has not been received or it has been received, that one we don't care about. We recognize revenue that has been earned in this financial period. The same applies to expenses. We recognize expenses that have been incurred and not paid. I mean, you have those that have been paid for and those that are still pending that we expect to pay in the next financial period. So I hope that one has gone down well for each and every one of us. And as I always say, kindly gather the information and find a way of defining accrual concept in your own way. It will be best for you to get your own definition rather than cramming a definition that you got or gathered from another source. Understand, design your own way of defining that concept. The second concept that we have here is called consistency concept. This is a concept which states that once a business chooses to use a specific accounting method, it should continue using it on a go-forward basis. By doing so, financial statements prepared in multiple periods can be reliably compared. Actually, that is the main intention of using the consistency concept. What does this mean? It means the policies that you use in preparing your financial statements, you are supposed to apply those policies consistently without deviating to take a different policy because of the new emerging trends. So if at all you have to deviate from the policy that you used to develop, or rather the policy that you used to do with as you prepare your financial statements, then the cause of deviation has to be given out clearly. You have to indicate that it comes out as a disclaimer to any person who is going to use the financial statements that you've developed. So you give it out clearly in the notes that this financial period, unlike in the previous financial periods, we have used this kind of policy to develop these financial statements because of 1, 2, 3, so that it becomes clear. For example, if you used, while depreciating assets in the prior periods, you had used the straight line basis, then in this financial period, you've decided to use a different approach or a different policy for depreciating those assets. It is important to indicate that there. Otherwise, you have to stick to the straight line basis that you had used in the prior periods. That is the concept of consistency. So, and we are being told that the main aim or the importance of doing that is you can be able to compare one by one on both sides. You have assets. We normally have comparative lines of the prior year's financial statements and the current year's financial figures so that we compare them. But we cannot do a comparison if you developed or rather used a different financial policy in the previous year and this year you are using a different financial policy without giving an explanation. I hope that one is now well understood. Now, the third concept of accounting is called Economic Entity Concept. This concept states that the transactions of a business are to be kept separate from those of its owners. By doing so, there is no intermingling of personal and business transactions in a company's financial statement. What we mean here is that simply we are trying to pass an information that a business is a separate entity from its owner, and therefore the business transactions that relate to the owner, they are not supposed to be featured in the business statement. Otherwise, that will distort the financial statements of the business. An example in this circumstance is if we have a business owner called Mr. Omolo. Now, Mr. Omolo has established a business called Customer Focus Limited. So those are two different entities. Customer Focus Limited, that's the business that we are trying to handle its financial statements. Then we have Mr. Omolo's events or financial transactions that relate to his personal life. Now, we don't really need to recognize those transactions that relate to his personal life that do not touch on the business in the business financial statements. Otherwise, that will distort the information that is contained in the financial statements of Customer Focus Limited. By doing that, you will realize that at the end of the day, you will be misleading the users of those statements. So for example, let's say that Mr. Molo has used cash 2 million to purchase a car for his wife as a birthday gift. And the source of this cash is from personal sources. Or rather, you are being told, you are being given a statement that Mr. Molo used cash from his pocket worth 2 million to purchase a car for his wife. Now, we come to the definition of economic entity concept. Economic entity concept states that the transaction of a business are to be kept separate from those of its owners. By doing so, there is no intermingling of personal and business transactions in a company's financial statements. This is to mean that the business owner is a separate entity from the business. We have a statement saying that Mr. Omolo, who is the business owner, owning a business called Customer Focus Limited, we are told that Mr. Omolo purchased car worth 2 million for his wife as a birthday gift from his pocket. That is different from when it is stated that Mr. Omolo used cash from the business to purchase a car worth 2 million for his wife as a birthday gift. The earlier circumstance was from his pocket, which means that money has not come from this business called Customer Focus Limited. So that is something that doesn't relate to the business. Then the second scenario is where he's using cash from the business to purchase a car that is gifting the wife for a birthday. In the second circumstance, you realize that cash is coming from the business, and Mr. Molo, being the business owner, he is affecting the capital that he has introduced into the business as an investment. So that will reduce capital, and a reduction in capital is the drawings. So Mr. Molo has done something called a reduction of capital in the business Customer Focus Limited. Yeah, so in this case, we have got two almost similar transactions, but they are supposed to be treated differently because of the economic entity concept. I hope that one is clear. In case you did not really understand that well, kindly just leave a comment at the comment section there. I'll be able to handle it. Then we also have the fourth one. We have the fourth one, which I really love most, called Going Concern Concept. Financial statements are prepared on the assumption that the business will remain in operation in future periods. Under this assumption, revenue and expenses recognition may be deferred to a future period when the company is still operating. Otherwise, all expense recognition in particular would be accelerated into a current period. What this thing means is the business is supposed to make an assumption that it's going to operate for the foreseeable future. The foreseeable future normally is being used to mean the next 12 months of the lifetime of the business. So from the point of giving the financial statements, you count 12 months. Is it possible that the business can still be in operation for the next financial period? If that is true, then we say that the business is a going concern. So the going concern concept is whereby we can be able to use the accrual concept that we had talked about earlier, that we recognize incomes and expenses on accrual basis. We have not received them, but we are optimistic that we shall receive them. We shall receive them in the future periods. So that one can only be done under going concern. Then the fifth one is Materiality Concept. This is a concept which states that transactions should be recorded when not doing so might alter the decision made by a reader of a company's financial statements. This tends to result in relatively small size transactions being recorded so that the financial statements comprehensively represent the financial results, financial position, and cash flows of a business. Just to give you an example that can lead you into understanding it further, let's say a business has been involved in a court case, and during the process, there is a fine that was levied on the business amounting to $500. So this $500 would be treated differently. It is a fine worth $500 in a business. So as you capture your expenses, this will be part of the expenses before you end up with your profits or surplus. The materiality concept here is all about trying to recognize that aspect of the transaction. the $500 that has been charged, is it material? Is it significant enough for it to be shown separately as a line item on the financial statements? Or is it an insignificant? Is it so minimal? Is it so minute? I don't know the term that I can use, but I hope now you understand what I say. If it is so insignificant, then you can just put it together with other expenses. And now, how do we know if an item is significant? Does it have value? Does it have weight in the business? Now, this is how we'll get to know. You check the operations of the business. If a business is a small scale business, then you will realize that $500 is a very huge amount for that business, and therefore that is so material. And if it is material, it should be shown clearly as a line item in the financial statements. If it is $500 and it is meant for a multi-million-dollar business, then that would mean that the $500 captured as part of other expenses, because it doesn't really affect the business so much. It will not really affect the economic decision of the financial statement users. Now, we have the sixth one, which is called the matching concept of accounting. This is a concept that states that the expenses related to revenue should be recognized in the same period in which the revenue was recognized. By doing so, there is no deferral of expense recognition into later reporting periods, so that someone viewing a company's financial statements can be assured that all aspects of a transaction have been recorded at the same time. An example in this circumstance, you may realize that you have incurred the cost of sales in this particular period, while the sales revenue in cash has not been received yet. So you are optimistic that you are going to receive the sales revenue in the following financial period. Now, if you recognize the cost of sales in this particular period, and then you take the revenue that is associated with this sales cost, then to some extent you are not matching them. So for you to be able to obey, or rather abide by the concept of matching, you have to bring them to a particular period. And the accrual concept will allow you bring back the sales revenue that you expect to receive in the following period, to bring them back to this financial period. So the matching concept states that the expenses related to revenue should be recognized in the same period in which the revenue was recognized. The next concept that we need to talk about here is Prudence Concept. In accounting, Prudence Concept, also known as Conservatism Concept, is a policy of anticipating possible future losses but not future gains. It implies that when choosing between two solutions, the one that will be least likely to overstate assets and income should be selected. Now, in short, what we are saying, you remember we had mentioned about the accrual concept, which was saying that incomes are recognized when they are earned, unlike when they are received, while expenses are recognized when they are incurred and not when they are paid for. In other words, what we are saying, the prudence concept states that we are supposed to recognize incomes when it is received and not when it is earned. We have the bit of income that is earned, and there is the extent to which we may say that this particular amount has been received so far. So to the extent of realization, the one that has been realized, the extent of income that has been received in the organization, that is what we recognize in the books according to Prudence Concept. Remember, Accrual Concept was saying something almost different from that, almost the opposite of the same, saying that incomes are supposed to be recognized in the books when they are earned and not when they are received. But here we are saying, as a prudent accountant, if you want to apply the prudence concept, you say you apply it by treating different transactions in the books, taking care of incomes that have been received only. Now, a case scenario is, let's say we are a firm that is giving services to our customers, let's say security services. So we have provided security services to another firm, and this firm is supposed to pay us. So if, let's say, the firm has not paid us for a particular month, that they are expecting to pay us in the subsequent year, then we shall only recognize the incomes that we received from that firm regarding the security fees charges, but not the one that they're anticipating to pay us in future. While for the expenditures that we've incurred in the process of trying to gain the revenue, we shall recognize that expenditure whether we have paid for it or we are intending to pay for it, as long as we have utilized the services that relates to that particular expenditure. Our next question is, what is the double entry concept? What is the double entry concept? This is a concept of accounting which states that every financial transaction has equal and opposite effects in at least two different accounts. For every credit entry, there must be a corresponding debit entry. You can see we have, yes, we'll be going by one major policy that asset is equal to liability plus capital. A is equivalent to L plus C. The capital is the same as equity. We'll come to the breakdown of capital, and we'll come to the breakdown of assets and liabilities in finer detail so that we can be able to understand. So if you have, let's say, you have expense that is being paid for, and it is being paid for in cash. So a transaction is given, for example, that a certain firm is paying 30,000 in the name of security services. That will be an expense to that firm. So security charges expense account will have security expense account against cash account. So what we are trying to say about the double entry concept is that if you do any reduction, if you do a debit entry on a particular account with a given amount, that same amount must be seen on another account, the same amount, or if the entry, or rather the transaction, is affecting more than one account, then you must have all the transactions on the credit hand side totaling to the same amount that was started with at the debit entry. So in short, we are saying our conclusion that double entry concept says that every financial transaction has equal and opposite effects in at least two different accounts. For every credit entry, there must be a corresponding debit entry. And if you do that, you will realize that your trial balance is balancing. You'll realize that your balance sheet is balancing. Now, as we were trying to define the double entry concept, we came across the word asset, liability, capital, or equity. Now, we need to define what these terms mean. Now, to start with, let's look at an asset. What is an asset? If you are asked to define what an asset is, this is how you'll go about it. Say, an asset is any resource owned or controlled by a business or an economic entity from which future economic benefits are expected to be derived. I would also put a different meaning or a different definition based on how we have gathered information from different scholars. So you you will also be able to define it in a different way after gathering information from here and maybe from other learning materials. I would also define it this way. I'd say an asset is any resource owned or controlled by a business as a result of past events and from which future benefits are expected. Future economic benefits are expected to flow to the business entity. An asset is any resource owned or controlled by a business as a result of past events from which future economic benefits are expected to flow to that particular business organization. We shall look into different categories of assets where we have got the category number 1 of fixed assets, then we go to current assets. So we'll talk about them and try to explain in details. But for today, just understand that the most important thing about the asset is that it is owned and controlled by a business, and this is as a result of past events. If the business took some loan to purchase computers, computers have been purchased as a result of that past event of taking the loan. So it is an asset owned as a result of past events in the organization from which economic benefits are expected to be derived. Economic benefits are expected to flow into the business. This asset that has been purchased is expected. We are not going to hire anymore. We are not going to hire computers anymore in the business for any operations. Instead, we are going to use the computers in the process of business operation, the computers that were purchased. So that is an asset that has given us some value in the process of business operation. So we still expect that this asset will still give us much more future economic benefits of the same kind. And just like any other asset, we may look into different kinds of assets and we'll see how they give us future economic benefits. Now, the next item that we are talking about here is a liability. We must have seen a liability in the equation. Asset is equal to liability plus capital. So we are talking about this liability here, and we are saying a liability is a present financial obligation of a company that results in the company's future sacrifices of economic benefits to other entities or businesses. A liability is a present financial obligation of a company that results in the company's future sacrifices of economic benefits to other entities or businesses. In short, what we are saying is that we have the most important bit of it is the present obligation, the present financial obligation. Like you have a debt, you have an obligation to settle, you have a debt to settle. That is the liability that we are talking about. So we have a present financial obligation. And I would also say we'll look into the different categories of liabilities where we'll talk about the current liabilities and the long-term liabilities, and we'll be able to define what they mean in each stage, and we'll be able to give you different examples of liabilities so that you can understand it better. Let's go to the next one is capital or equity. Capital or equity. Now for capital or equity, we would say equity represents the shareholder stake in the company identified on a company's balance sheet. Equity represents the shareholder stake in the company. Then other people also define it as the net worth of the business. Equity is the net worth of the business. Some would ask you what is the net worth of the business. In short, the net worth of the business is the shareholder's stake in the business. the owner's contribution into the business is the net worth of the business. So the net worth of the business can be used interchangeably with equity or capital. Equity represents the value that would be returned to a company's shareholder or shareholders if all of the assets were liquidated and all of the company's debts were paid off. When the business is being wound up, first we start by paying the liabilities, and then at the end of the day, we pay the owners of the business. That is a fair distribution. So equity represents the value that would be returned to company's shareholders if all of the assets were liquidated and all of the company's debts were paid off. Now, liquidating here means selling them to change them back to cash. So if you are having, we had said, if you look at the equation that we had presented up there, we were having assets is equal to liability plus capital. It means that if we are selling all the assets, it means we are trying to get cash so that we can settle the liabilities and the capital. Let me say the total assets will be equivalent to the liabilities and capital. So when you are trying to liquidate all the assets, the major intention is to settle the present obligation, which is liability, and also the shareholders' contribution into the business. The next item that we need to define. Income is the total revenue generated by the sale of goods or services related to the company's primary operation. We receive income when we render services to other third parties, or when we sell goods, we expect to receive income. The next item is the expense. An expense is the cost of operations that a company incurs to generate revenue. An expense is the cost of an asset used by a company in its operations to produce revenues. We know that in every business, be it a business that provides or rather sells products, or a business that renders services, the ultimate goal is to generate revenue. So as the business is trying to generate revenue, there are some costs like the security fees, like some tax and what have you. There are so many things like water, the cost of power bill, things like that. At the end of the day, you'll be expected to pay for those expenses. And when you are preparing your financial statements, you are supposed to capture those ones, because if you don't capture them, you will exaggerate your profit, and then that will not be prudent for somebody who is an accountant and trying to give a true picture for the organization. It will be misleading to the people who are using financial statements of that organization. So it is important to capture all the expenses that have been incurred in the process of generating revenues for the organization. The next question that we are going to handle is about financial statements. What are financial statements? If someone asks you about this, you say financial statements are a collection of summary-leveled reports about an organization's financial results. They are normally presented in form of balance sheet, profit and loss account, cash flows, and changes in equity of the organization. The balance sheet, you need to know that the balance sheet is the same as statement of financial position, and profit and loss account can also be called income statement, which can also be called statement of financial performance of an organization. Then we have the statement of cash flows and changes in equity of the organization. Basically, those four form what we call the financial statements. So if somebody asks you about financial statements, now you know how to define financial statements. You just say financial statements are a collection, because you can see there are four. It's just a collection of summary level reports about an organization's financial results. So the four reports will give you an organization's results. What are the contents of financial statements? The contents of financial statements have been grouped into two. We have two different financial statements. We have the major statements, which are the balance sheet and the income statement. So under the balance sheet, we normally show or rather feature on the face of the balance sheet assets, liabilities, and equities. And we also have under income statement, we show the incomes, which can also be called revenue. We also show expenses. So the statement, or rather the contents of financial statements, we have assets, liabilities, equities, and we have incomes and expenses. A point to note, the balance sheet is also called the statement of financial position, and I would advise you, as somebody who has gone through some training, it is important for you to adopt the new name which has been given to it. Instead of calling it the balance sheet, which is known by everybody, what I mean is that those who have taken time to pay for training of accounting, like you who has taken time to do research on this channel, it is important for you to develop a new skill and talk like somebody who has gone through some training. So the balance sheet from today, call it the statement of financial position, and the profit and loss account, which other people call the P&L account. It is important for you, as from today, call it the statement of financial performance, and the statement of cash flows, statement of changes in equity of the organization. Now friends, thank you for listening to this video. If it was helpful to you, I want to request you to take some little time, click on the video, click on the channel, and maybe get to subscribe to the channel. Kindly, before you leave, kindly get to subscribe to this channel, and also remember to share, like, and comment. And whatever question that you have, kindly put it in the comment section there, so that when we come to the next video, I may sample a few questions with the questions that have been put forth. I will handle them and maybe give you a breakdown, and we can also do them together. Thank you so much. Welcome again to this channel.